Are you looking for the best dividend stocks to add to your portfolio in the new year? Well, look no further, because in this video, we'll be discussing 5 deeply discounted dividend stocks that you might want to add to your shopping list in January 2023, all of which offer a fantastic value at current prices and come with pretty impressive dividend stats that I think you're gonna like. But before we get to those, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. And also, leave me a comment below and let me know which dividend stocks you have your eye on. I'd be curious to hear what you think is looking good. Now, getting into the first stock, I think Kroger, ticker symbol KR, is a stock you definitely want to keep your eye on as we head into January 2023. Now, Kroger is one of the largest grocery store chains here in the US, with over 2,700 stores in 35 different states. And I first started getting interested in Kroger after I moved to Las Vegas a few months ago, where they own a chain of grocery stores called Smith's, which I can honestly say is one of the nicest grocery stores I've ever been into. Now, one of the interesting things about Kroger is that they own a lot of their own real estate, and through one area of their business, which they call Kroger Real Estate, they acquire, develop, and manage many of the properties that house their stores. So in addition to being a top-notch grocery retailer, they also have a pretty impressive portfolio of real estate assets. Now, taking a look at the share price performance, Kroger has seen a decline in share price in the last 30 days, or they're down about 4.2%. Now, zooming out and taking a look at their year-to-date performance, in 2022, Kroger is definitely hanging in there. They're up nearly 2% in the green, which is definitely more than we can say for the 3 major indices, the Dow, the NASDAQ, and the S&P 500. Here on the valuation page, Kroger has a forward PE ratio of 10.96, which is very low in its own right, but this is also 41% lower than the sector median and nearly 12% lower than the company's 5-year average. And scrolling down, taking a look at the rest of the valuation metrics, the price to book is a little bit on the higher end, 3.16, which is about 4.3% higher than the sector median and nearly 10% higher than the 5-year average, but the price to cash flow is looking really low, 5.11, which is 64% lower than the sector median and almost 9% lower than the 5-year average. So overall, taking the price to earnings and the price to cash flow, I'd say just based on these metrics, the valuation's looking pretty sweet. And the dividend stats are looking equally as delicious, guys. We can see that they have a forward dividend yield of 2.3%, which isn't anything out of this world, but for a company in the consumer staples sector, they're able to offer a lot of dividend growth, which is one of the more attractive features to this stock. And we can see that in addition to their very low payout ratio of just under 23%, their 5-year growth rate is sitting at about 14% on the dividend. So that's nice and high. And they have a respectable dividend growth history of 16 consecutive years. Now, having said all this, it begs the question whether or not Kroger is a good one to buy right now. And according to alphaspread.com, it's still looking pretty undervalued. On a worst case scenario, they give it an intrinsic value of $50.24, meaning it's about 11% undervalued. They give it a best case intrinsic value of $98.22, which means it's 54% undervalued, and they give it a base case intrinsic value of $62.75, which would mean that at current prices, Kroger is still nearly 30% undervalued. And just as a disclaimer, guys, you got to take these with a grain of salt. These intrinsic value calculations, there's a lot of room for error, and it can be pretty subjective. So just because AlphaSpread is easily able to spit out these numbers for us, it does not mean we should take it as gospel. It's just another metric that we can refer to when doing our evaluations. Now, moving on to stock number 2, I think Verizon is prime for purchase moving into the new year, guys. And this company is one of my portfolio's biggest losers. I'm currently down over 25% on my position, but such is life. And looking at their year-to-date performance, Verizon is down 26.7%, and we can see from the chart that for the last half of 2022, they've been on a pretty steep downward trend. But Verizon's losses are not just specific to 2022. If we zoom out on the max chart, which takes us all the way back to the early 90s, we can see that Verizon is down 15.5%. And I think there are 2 different ways you can look at this. Number one, you could look at this and say the capital appreciation with Verizon is non-existent, okay? The company is going nowhere. They're seeing nothing but negative share price returns across the last 30 years. Why would I want to invest in a company like that? Or number 2, you can look at Verizon for what it is, which more than anything is a stock that you buy for the cash flow returns instead of the share price appreciation, and say, hey, this stock is beaten down in share price, which means that the real benefit to owning it, which is the cash flow returns, right, is going to be higher than usual. So maybe there's an opportunity here. Now, whichever way you choose to see it, I think depends on what you're looking for in an investment. If share price appreciation is something that's important to you, then you'll likely want to pass on Verizon, which is totally fine. But if you're after those dividends, then now might be a pretty good time to strike. Taking a look at their forward dividend yield, it's currently sitting at 6.81, which is pretty high in its own right, but this is also 46.25% higher than the company's 5-year average dividend yield. And furthermore, the rest of the dividend stats aren't looking too shabby either. Their payout ratio is still still in a decent position, under 50%. The 5-year growth rate isn't anything special, but they do have a high yield today, so there is a trade-off there, but the dividend growth history is looking pretty respectable. They have 18 years of consecutive dividend growth, so they do have a history of not only maintaining that dividend, but continuing to grow it over time. And getting into Verizon's intrinsic value, alpha spread gives them a worst case scenario of $36.17, which means that they're still 4% overvalued. They give them a best case scenario of $123.22, which means that Verizon would be 69% undervalued, which honestly seems a bit unrealistic to me, and that's why I say you gotta take these numbers with a grain of salt. And they give Verizon a base case intrinsic value of $53.99, which would mean that it's still 30% undervalued. So really guys, it could go anyway. Now getting into the third stock, we are going back to the consumer staples sector and talking about Tyson Foods, ticker symbol TSN, which we did cover in last month's video talking about the best stocks to buy in December, but honestly, it's looking like an even better deal now, guys. Just in the last 30 days, Tyson has dropped another 8.5%, which puts them at a year-to-date loss of about 30.2%, and the valuation is looking prime for purchase, guys. We can see here that they have a forward PE ratio right there in the single digits, 9.35, which is nearly 50% lower than the sector median, and this is also 18% lower than the company's 5-year average. And scrolling down, taking a look at the price to book, this is sitting at 1.05, which means that Tyson is trading right at their book value, guys, and this is 65.3% lower than the sector median and nearly 40% lower than the 5-year average price to book, so definitely a discount there. And that last metric, the price to cash flow, couldn't be better. It's 6.35, which is 55% lower than the sector median and 43.5% lower than the 5-year average. And like Kroger, this is another one of those in the consumer staples sector that offers a high amount of dividend growth, and the forward dividend yield's not too bad either, 3.15, and that 5-year growth rate is sitting at 13.8%, so very high with a very low payout ratio to match 21%. So a lot of room to continue growing the dividend, and at the very least, this dividend is not financially stressing the company out too bad, which is great for us investors. And furthermore, they have a pretty decent growth history of 11 straight years. Now, according to Alpha Spread on all fronts, Tyson is looking pretty discounted. They give it a worst case intrinsic value of $83.36, which would mean that at current prices, it's nearly 30% undervalued. They give it a best case of $179.45, which would make it 67% undervalued, which honestly, guys, just seems ridiculous to me. I don't think the stock's ever been up that high. And they give it a base case of $106.38, which would make it 44% undervalued, which also seems high to me, guys, especially considering the highest that this company has ever been was earlier this year, where it reached nearly $98 per share. And now getting into the fourth stock, this is Kilroy Realty Corporation, ticker symbol KRC, which is becoming one of my favorite real estate investment trusts and was my 5th most purchased stock in 2022, with my position currently sitting just below 40 shares. Now in the last month, KRC has seen quite a dip. They're down nearly 5.5%, and year to date, it's looking even worse, where they're down nearly 42.5%. And I would not be surprised if this negative share price performance continued until we see an overall change in the market or until offices come back into favor, which a lot of their portfolio is in office space, where they lease to tenants like Adobe, Amazon, Comcast, Facebook, Google, and Salesforce. But in the meantime, KRC is still putting up really good numbers and did not skip a beat at all during the pandemic or really at any point leading up to it. Taking a quick look at their financials, we can see that KRC's total revenue has continued to grow without pause, at least for the last 10 years. And scrolling down, taking a look at their adjusted funds from operation, we see a similar trend here, which is important because this is what they use to pay the dividend. And on that note, taking a look at their dividend stats, KRC is a high yielder. They have a forward yield of just about 5.5% with a 5-year growth rate that's pretty much exactly the same number, about 5.6%. And they have somewhat of a dividend growth history, 6 consecutive years, which just based on what we saw in the financials, I expect them to continue. And KRC's valuation is looking pretty sweet. They are currently trading below their book value with a price to book of 0.84. And if we scroll down and take a look at the P to FFO, which is like the real estate investment trust equivalent of the PE ratio, this is sitting right there in the single digits, 8.43, which is incredibly low. And Alpha Spread is once again showing us some intrinsic value numbers that are indicating undervaluation across all fronts. Worst case scenario, they have KRC valued at $51.38, which means it's currently 25% undervalued. They give it a base case of $60.80, which means that it's 37% undervalued, and they give it a best case scenario of $87.83, which would make KRC 56% undervalued, which is right about where KRC peaked at right before the start of the pandemic in 2020, as we can see from the share price chart. Now moving on to stock number 5, sticking to the real estate sector, we're talking about Medical Properties Trust, ticker symbol MPW, which at this point might just be the most discounted REIT on the market, guys. In the last 30 days, they're down 13%, which is unbelievable, especially considering that year to date, they have a negative share price performance of 52.6%. And as I'm sure you can imagine, just considering considering how substantial these share price drops are, it's gonna put MPW's valuation right there in the sweet spot. Taking a look at their price to book, this is even lower than KRC's, where they're trading even further below their book value at 0.79 for the price to book. And scrolling down, looking at the P to FFO, this is also lower than KRC's, 6.48, which is 52.5% lower than the sector median. And as we take a quick look at the financials, here you guys will really see just how much of a steal MPW is right now. Looking at their total revenue, just like KRC, this has gone up pretty aggressively across the last 10 years, even more so than KRC, I'd say. And also scrolling down, looking at the adjusted funds from operation, guys, look at that slope, trending upward very aggressively. So every year they're able to contribute an increasing amount of money to the dividend, and it definitely shows, as their dividend yield there is nice and high, 9.91%. Very high dividend yield. And the 5-year growth rate's okay, considering how high the forward dividend yield is, 3.86% for the 5-year growth rate. And they've been growing this dividend for the last 10 straight years. And MPW is such a steal that Alpha Spread is giving them a worst case intrinsic value of $19.72, which would make it 48% undervalued. They give it a best case of $33.75, which would make it 69% undervalued, which seems a bit high to me considering the highest the share price has been in the last 5 years is around $24 per share, which we can see here. And lastly, they give it a base case of $23.91, which means that Alpha Spread expects MPW to return to all-time high share prices, and this would make it currently 57% undervalued. Now, those are the 5 main stocks that I think look like incredible deals moving into January, but there's still quite a bit more than I think you should have your eye on. The first one, believe it or not, is Apple, who is down 13% in the last 30 days, which is such a big drop, and this puts them at a year-to-date loss of about 28%. The next one is Bank of America, who's seen a similar drop in the last 30 days, down 13.5%, which puts them at a year-to-date loss of nearly 30%. Citigroup is another one I think you need to keep your eye on. In the last month, they're down 10.3%, and year-to-date, they're down also 30%, very similar to Bank of America. Moving on, HPQ is another one that's looking pretty sweet, guys. They're down 9.5% in the last month, and year-to-date, they're down also 30%. They have a nice single-digit PE ratio sitting right above 8, which we can see on the right-hand side of the screen. And I know a lot of you guys out there like this one, IIPR, who is down 13.3% in the last month, and year-to-date, they are down a whopping 60%, so that's quite a big discount. Another one to keep your eye on is Medtronic, who's only down 1% in the last month, but year-to-date, they've seen a pretty big loss, down 27%. And then Qualcomm, guys, who is down 12.25% in the last month. Big drop, and they're down over 40% year-to-date. And look at that PE ratio on the right-hand side. That is getting really close to being in the single digits. And I gotta throw this one in there, guys. Intel, who was down 13.5% in the last month. And I know a lot of you guys out there have actually been picking up some Intel. I've seen it in the comments, I've seen it in the Discord, and year-to-date, Intel is down over 50%. Moving on, guys, this stock finds its way on this list every single month. This is Scott's Miracle-Gro, who is down over 16% in the last month, and year-to-date, they are down over 71.5%. This might be the biggest drop out of any stock I've seen in 2022. And now there's just a few more, guys. Stanley Black & Decker is the next one I think you should keep your eye on. This is down 9.8% in the last month, so a pretty big drop, and year-to-date, they're down about 60.5%. And this next one, guys, Target has seen such a big drop in the last month, down 13.5%, and year-to-date, they're down about 39%. And then last but not least, we have T. Rowe Price, who's also seen double-digit losses in the last month, where they're down nearly 11%, and then year-to-date, T. Rowe is down about 43%, so quite a big drop. And now that you guys are clued in on some of the best stocks to buy as we head into the new year, if you want to learn about a handful of more stocks that I'm planning to buy in 2023, check out this next video where I'll also reveal my entire investing strategy for this upcoming year. So click right over here, and I'll see you in the next one.